Hello, savvy investors. Let's talk about Silicon Valley Bank that just went belly up and the lessons we can learn from the 16th largest bank in the United States going belly up. Lesson number one: as a depositor, as a customer of a bank, make sure your account is below the $250,000 limit that is insured. The FDIC will make you whole for your deposits as long as it is below $250,000. Now, they play games with this stuff, so you have to be sure. Is it per account or per individual? And I believe it is per individual. So make sure your deposits are below $250,000 in any individual bank. If you had, say, a savings account with $300,000 at Silicon Valley Bank, the FDIC will make you whole for $250,000. The other $50,000 has just evaporated. So you have to be conscious of that. Lesson number two: stay diversified. Stay diversified. What did Silicon Valley Bank do? They invested all their deposits in long-term bonds. And as interest rates started to rise, the value of their entire bond portfolio went down. So they were in a bad shape. They were in a bad situation. Stay diversified, my friends. Diversification is your friend because nobody can predict the future. Number three, look north, look to Canada. Canadian banks operate under more stringent, more conservative, more disciplined principles. Think Royal Bank of Canada, think TD Bank, think Bank of Montreal, Bank of Nova Scotia, and National Bank. Oh, and CIBC. The Canadian banks operate under much more stringent, disciplined requirements. Consequently, fewer Canadian banks go belly up compared to American banks. Stay diversified, my friends, and stay below the FDIC limit, the Federal Deposit Insurance Corporation. Your insurance, your deposit in banks are insured up to $250,000. Stay below that level at each bank. Have a wonderful day.